Today we are going to discuss about direct and indirect taxes from income tax of fourth semester. Here there is a classification in taxes. One is direct taxes and the other one is indirect taxes. So direct taxes is a tax on one in which the immediate and ultimate burden will be on the person. So direct taxes are those taxes which are imposed on a person either on his income or wealth, and the tax liability cannot be transferred to the other person. So here the person whoever earning the income of his personal income, if the personal income exceeds the limit which is decided by the government, so the person has to pay the tax. So it is a burden on the person who is earning the income, so he is liable to pay the tax within time. So the income tax and professional tax are example for direct taxes, because the tax is directly imposed on the income of a person or entity or firm which is earned by the person or the individual during the last financial year. And the other one is indirect taxes. Indirect taxes are the taxes which are levied on the price of goods or services. So then it is known as the indirect taxes, because here the tax is not paid by the person directly to the IT department. Instead, he is paying the service or the goods which is he is buying, or he is receiving services. So for that he has to pay the tax. Those are taxes included in the price of the goods or services. So it is these taxes are not directly paid by the person to the IT department. So these taxes are included in the price of a goods or services. The person has to pay the tax including the price when he is buying or taking services. So indirect taxes are collected by middlemen in the channels of distribution of goods, and it's remitted to the government treasury. So here the taxes are collected by the middle persons. Those could be wholesalers or retailers or the brokers who are selling the products or services. They will collect the tax on the price on the product or services. So those collected taxes are paid to the government of treasury. The examples for indirect taxes are sales tax and transportation taxes and custom duty, excise duty, service tax. These are the examples for indirect taxes. So this is a broad classification of taxes which we can understand that the direct tax is charged or levied on person's personal income, and indirect taxes are included in the price of goods or services. Next our topic is assessee. So assessee means according to section 2 subsection 7 of Income Tax Act 1961, assessee means a person by whom any tax or any other sum of money such as interest or penalty is due under Income Tax Act, or in respect of whom any proceedings under the act has been taken for the assessment of his income. So the person, the best example, or in simple words we can say, if any person or firm earning the income which exceeds the limit decided by the government, the person or the firm or association of persons has to pay the tax. So if a person's income is more than the limit which is decided by the government, the person becomes assessee. So the person is payable tax on his income which he earned in the financial year or in the previous year. For the assessee of his person income, a person who is liable to pay any amount. So as we discussed, types of assessees are different. One is person, the person who is liable to pay any amount due to the income tax department towards tax penalty and interest is known as assessee. There are other types of assessees also there. Here, persons includes individuals, Hindu undivided family, firms, companies, and non-profit organization are all called as assessee because these firms and individual will earn income, and if it is exceeds the limit, then these all are become assessees. Now there are a second type of assessees, deemed assessee. Deemed assessee means generally the person whose income exceeds the limit is liable to pay tax. But if such person is minor, or in case of lunatics, so in case of minor, the parents are responsible to pay the tax. When the parents will become responsible for paying tax means if the minor earns income and if it is exceeds the limit, then the parents are responsible to pay the tax. If the parents are fail to pay the tax, those people will be responsible for legal action. And in case of lunatics, the representatives such as guardian, trustee are liable to pay the tax because lunatics will not be in the sound mind. So the representatives such as guardian, which is appointed by the court or which is appointed by the person himself, so the guardian will become responsible for paying tax to the IT department. So there are so here deemed assessees are trustee of trust, legal guardian of a minor, or the examples for deemed assessee who are responsible for paying tax on behalf of minor, on behalf of the persons who are earning income, but if they are minor or lunatics. There is another type of assessee, that is assessee in default. Assessee in default means when a person violates the provision of the act in discharging his duties, then is known as assessee in default. So here the default assessees are if a person fails to deduct the tax and remit the tax to the deducted fully to the IT department, then the person will become assessee in default. If a person failed to pay advance tax, so in these two cases the person will become assessee in default, because nobody has to confirm the person as assessee, but definitely the person will become assessee in default. So the person has to pay the tax to the government with penalty. Next is assessment year. Assessment year means the period of 12 months commencing from 1st April to 31st March. The current assessment year is 2021 and 22. During this period, the total income of a person is calculated. So here, assessment year means the calculation of income which is earned by the persons or different persons. So those can be individual, those can be firms or companies, HUF. So whoever earning the income, those are calculated in the assessment year. So this assessment year starts from April 1st and it will end in the 31st March. Previous year is also known as financial year, which means if the person earned income within period of 12 months, which is calculated in assessment year. So here now the previous year for this assessment year is 2020 and 21 is the previous year for the assessment year. The previous year means the financial year, the person earns income in that year. So whatever the income earned by the person in previous year, he is liable to pay the tax in assessment year. So here the previous year is 2020-21 for the assessment year 21-22. So now the next topic is income tax rules. So there are some rules for payment of tax for deciding the person is assessee or not, and there are some rules and regulations which they have to follow when paying tax or calculating tax or collecting tax. So here the Income Tax Act 1961 rules are taken from the act. The first rule is every person who earns income in India has to pay tax if the income exceeds the limit. So the person earns income in India, and if it is exceeds the limit which is decided by the government, the person has to pay tax to the government. So the next thing is anyone living within the territories of India is liable to pay tax in tax. Sometimes if the person earned income in foreign countries also has to pay tax. So in Indian territories, so within the Indian territories, if a person earns income, then the person has to pay tax. Even sometimes if a person earning income in other countries, but the person has to pay tax to the government in some cases. And there are income tax heads which the tax is calculated by giving some exemptions, by giving some deductions. And here these are the heads of income from salary. So income from salary means if a person employed in any company or in any kind of thing, if the person is getting salary for every month from the employer, then the person that income called as income from salary. The next head is income from house property. If a person holds more than one house property or even one house property, if the person earns income from the that house by letting it to for rent or for a lease, if the person getting the income from that house, so then that income called as income from house property. And the third head is profits and gains from business or profession. If a person is a professional, is working on his own profession and is earning gains or incomes, profits through that profession, that person has to pay tax. And as well as the business, if a person doing business, the person has to pay tax. And capital gains, are the investments which are made by the person into different uh, areas, and income from other sources. So if any income cannot be included above four heads, then those incomes comes under income from other sources. Here, in the income, if the income is not fitting in income from salary, house, property, business, or profession, capital gain, those incomes comes under income from other sources. And there is a formula for calculating income. So computation of income. So here total income equals to gross total income minus deductions under section 80C of Income Tax Act 1961. Then the gross total income is calculated as income from all heads. That means income from salary, house, property, gains from profession or business, capital gains, and income from other sources, including all together from 5 heads. So that income is calculated plus income under clubbing. So income from clubbing means it is a income from agriculture, non-agriculture activities. So those are added to the gross total income, and if there are any losses, so those are deducted from the gross total income. Today we are going to discuss about the exemption to the general rules of income tax. These are the exemptions which are given to the assessees from calculating tax. So person leaving India within an intention not to return to India during the relevant assessment year. If a person that means 2020-21, if a person leaving completely from India and moving into other country, so that person is exempted from income tax. And there is another exemption rule, that is income of non-resident shipping companies has to pay tax if the passenger or cargo before leaving the port in India. If a company has to pay some tax on cargo which is leaving from India, but it is not a Indian company, still they also have to pay tax before leaving. Next, the next exemption rule is income of discounted business under section 176. Any person discounting the business or profession shall inform income tax department within 15 days. If any person claiming deduction according to Income Tax Act 1961 section 176, the person has to inform before 15 days to income tax deducting claiming deducting from business or profession. Next, person trying to transfer the assets to avoid tax, section 61. So these comes under capital gains. If any person having more assets which are chargeable on income tax, so if the person is transferring those assets to the another person, so those that percent of tax is exempted from the assessee. Next, income of bodies formed for short duration. So if persons associated for short duration, that means very less period. For example, best example is for joint venture is the best example for exemption of tax under this exemption rule. Now let's discuss person once again. Person is a natural person or HUF or a company or firm or an association of persons or body of individuals or a local authority, and every artificial judicial person comes under as person. So the person can be a natural person, artificial person. So in income tax, in these terms, all these terms considered as person. Now let's see the residential status of an individual. So if a person if we are saying a person has SSC, the person should fulfill the conditions of residential status. So let's see the conditions. So there are two conditions for determining residential status of an individual. So one is the basic condition and the second is another. So basic conditions are, there are two basic conditions which a person has to fulfill before while calculating residential status of an individual. So the person should stay in India for 182 days or more in previous year or in financial year. And the next condition is the person should stay 60 days in previous year plus 365 days in last 4 years. So these are the basic conditions if for a person should fulfill for his residential status. That means whether the person residing in India or not, because according to Income Tax Act, whoever residing in India, whoever the residents of India, that person has to pay the tax. In very special cases, the foreign income can also be calculated under income tax, but 99% of income taxpayer should be resident of India. So the person should definitely fulfill the residential status for calculating the income tax on his income. So the basic conditions are the person should stay 182 days in or more than in India. And the second basic condition is 60 days in previous year and plus 365 days in last 4 years. These are the basic conditions that person has to fulfill. If a person fulfilling these basic conditions, then the additional conditions are applied. So if a person fulfilling the basic condition, that person is called as resident. If a person fulfilled the basic conditions, then there should be application of additional conditions. So the additional conditions are the person should resident for 2 years out of last 10 years. From last 10 years, the person should be resident for 2 years from those 10 years, and the person should stay in India for 730 days in last 7 years. So if the person fulfilling the both conditions, basic conditions and additional conditions, then the person called as resident and ordinary resident. So now let's see the application of conditions for calculating the residential status of an individual. First, determine whether a person satisfies basic conditions or not. So first the person, we should apply the basic conditions and we should see whether the basic conditions are fulfilled by the person or not. If satisfies one or both basic condition, then he will be treated as resident. So if the person is fulfilling the basic condition, that person called as or treated as resident. Next, if a person fails to satisfy any one of conditions, then he will be treated as non-resident. If a person fails to fulfill the basic conditions, first in every person's residential status, the person definitely fulfill the basic conditions. If he fails fulfilling basic conditions, then the person called as non-resident. The next thing is, if the status of a person is resident, so after fulfilling the basic conditions, the person will become resident. So then only apply the test of additional conditions. So if the person is fulfilling the basic conditions and he is declared as a resident, then the additional conditions are applied to decide the residential status of a person, whether the person resident and ordinary resident or not. So if an assessee is a non-resident, then the test of additional conditions are not applied. So if the person failed to fulfill the basic conditions, then the person becomes non-resident, so there is no need of applying additional conditions to the that non-residential status person. If an individual satisfies both the conditions of both the conditions, the person is resident and ordinary resident. If the person fulfilling the conditions, basic conditions and additional conditions, then the person called as resident and ordinary resident. Then if a person satisfies any one of two or none of the additional conditions, the person is resident but not ordinary resident. If a person fulfills the both conditions, then the person treated as resident and ordinary resident. If a person is only fulfilling basic conditions, and if the person is not fulfilling the additional conditions, then the person called as resident but not ordinary resident. That means he may be not resided for 2 years from last 10 years. So then the person called as only resident but not ordinary resident. Now let's see the residential status of a Hindu undivided family. So here in Hindu undivided family, HUF, Karta is assessee for the family income. So because in Hindu undivided family, the business belongs to the total family. Each member of a person, each member of that family is a partner in the firm. So here the Karta is the assessee. So because he will be organizing the business, so he will be the assessee for the income which is earned by the family company. So he is liable to pay tax. So the members of a family are known as co-parences, are not liable to pay tax. So the family members are the partners in the business, but they are not liable to pay tax. The Karta is liable to pay the tax. The Karta is treated as assessee. So the member of families are liable to pay the tax on their personal income. So if the family members are having their personal income which exceeds the limit of the which exceeds the limit of decided by the government, the person is personally liable to pay the tax on his personal income. Next, application of conditions for calculating residential status of a Hindu undivided family. A HUF is said to be resident in India if the control and management of its affairs is wholly or partly situated in India during the previous year. So for calculating the residential status of HUF, so the HUF is called resident if the HUF are doing their business completely within Indian territory or partly in Indian territory last previous year. So then the HUF is called resident. So if the control and management of its affair are wholly situated out of India, then the HUF will be treated as non-resident. So it is clear if the HUF not related to if they are not conducting their business activities in India, then it is the HUF is a non-resident treated as non-resident. In case of companies and firms, so the rules which we applied to HUF, the same rules also apply to the company and firm. If the company is doing or conducting their business activities in India, partly or wholly, then the company is called resident. If the company maybe it is an Indian company, but if the company it is not conducting their business activities in India, then the company called as non-resident. But here in HUF the Karta is assessee, but here the company it is artificial person. So on the seal of and the company name, the tax is calculated and the tax is paid by the board of directors or the company secretary, by the company secretary. So, incidence of tax. Now, the next topic is incidence of tax. Incidence of tax means the burden of payment of tax. In simple, it denotes tax liability of a person according to Section 5 of the Indian Income Tax Act. Under Section 5 deals with the total income. So, incidence of tax means the amount of tax which the assessee has to pay to income tax department. So the incidence of tax comes under Income Tax Act Section 5, and the Section 5 deals with the total income. So the tax liability of an individual depends upon his her residential status. So as we discussed earlier, the tax liability is totally depends upon whether the assessee is resident or not non-resident. If the person is resident, the person has to pay the tax. If the person is not resident, so there is no need of paying tax to the income tax department. Next, classification of income. So income, there is two types of income, that is income in India and foreign income. So income in India, that means income earned, received and deemed income to be received in India are treated as Indian income. So income earned, if the person already earned income, and the person has to receive income, and deemed income. Deemed income means that future income which will be received by the assessee in future. So those three incomes are called as income in India. Now there is another type is that is foreign income. If the source of income and receipt of income are in foreign country, then the income received by the person shall be treated as foreign income.